Hello everyone. So this will be our last video of monetary policy, which is part 5. And in this video, we're going to talk about the futures of monetary policy official year 2020 and 21 in context of Nepal. So the number one point is economy recover after COVID-19. Number two, expansionary monetary policy. Number three, lower interest rate. Number four, credit to private sector. Number five, official financial sector stability. Number 6, inflation stability. Number 7, digital banking system. So now here we come to the number 1, economy recover after COVID-19. As we know that after the COVID-19 pandemic, our economic growth had fallen really harder, that it hit our entire economy, entire country, and every citizen was suffering for oil, for petrol, for diesel, for fruits, for rice, for grain, for fertilizer. These were the common things we saw in our economy after that COVID-19 pandemic. And about the trade, like we're going to talk about a lot of things in this economy recovered after COVID-19. And let's see like how this government handled, like the government supported the small business, and some economic activities done by the few people, done by the government, done by the private organization. So like NRB had just one focus, which is to recover economy which is affected by the pandemic after that COVID-19. So yeah, in this point we will be just talking about this. And yeah, in this video, like I will just talk this little, but I know that in exam I can write down, so I'm just not gonna come to the point like yeah, but in exam I'll be writing like futuring, this point highlight, like how does it affected, and how did government support it. Government, it means like Nepal Rashtra Bank, the central bank, in simple words. And yeah, number 2 point is expansionary monetary policy. After the economic growth, when it goes less, our government fully went to the expansionary monetary policy, because we know that we have got like one, monetary policy follows like the two direction, which is expansionary or contraction, and right now after the COVID-19 we had no choice that we gotta follow the expansionary, because as expansionary says that when economic growth is low, you gotta follow this. How? Decrease the inflation rate, decrease the not inflation interest rate, and you will have increase the money supply, increase investment, productive, more job, economic growth. Like this is the simple way to understand this. All right, so now number 4, lower interest rate. As I already told you, when the lower interest rate, people will be taking more amount of money from the bank loans, in terms of any things, fixed deposit. There won't be, like, there will be a lot of investment and a lot of productive activities, and a lot of money will flow from there. Money supply goes high, economic growth highs. Or we can take as like an example, inflation rate is high, government decrease the interest rate, increase the interest rate when inflation is high. It's really obvious. Less loan become not cheaper, expensive. People will take less loan, means less investment means less money supply, less money flow, inflation falls. And basically it's done when the price of goods are really high. Okay. And number 4, we come to credit to the productive sector, which is the supporting small business, like tourism, small business, and agriculture. And like we got some industries supporting them in order to enhance the economic growth. After COVID-19 we could talk about that, or just write down, even if I'm talking this much about some certain point of topic, but in exam when I do write down, like it will be like as 8 to 10 lines already. So and that's enough for exam, 1.2 explain. But I gotta write about the main topic, like I'll be not writing down as okay, it is really important for the entire economy. Oh, not this type of topic. Like I will just come forward, why we gotta hand over this credit to the productive sector, because due to this like we could increase the economic growth or decrease the inflation rate. So yeah, inflation rate, yeah. So just talk about this main point. And the number 5 is financial sector stability. It means citizen having trust overall the banks, you know, maintaining their trust, it means, and having that solving the problem issue, and like reduce risks of financial risks, like reducing the risks. It means simply that, maintaining stability in bank. Like what did our government central bank did was, like they wanted to make sure that after the COVID-19, that there won't be any instability in a bank in certain way we could understand, like in such a, like like a solving problem issue or reducing the risks, there could be scams. So maintaining their trust, it's really important for the public. Like if bank doesn't, sorry, if citizen doesn't trust the bank, so there won't be too much of taking loans from so certain banks. So they want to make sure that you gotta, like there were some strict rules and regulation formulated by the central bank due to that time, because there were a lot of scams handling were being thrown to the citizen, and people would not trust that. And then there were some difficulties we had faced, like for 6 7 months I had read that on newspaper. So yeah, we just gotta talk about that topic. And then we got some digital banking system. It means that NRB encouraged the banks for the digital transaction, likewise like QR payment, online transaction, and like mobile banking, like, and the purpose was for the easier financial transaction and faster transaction. So there will be more money supply, obviously. And the last one we're going to talk about is inflation stability, where the it means the controlling price and maintaining the stability. Like we could talk about how we control the inflation. So that's it, guys. This is it for the video, and we are done with our monetary policy, its types, its objective, instruments, feature, conclusion. And yeah, guys, this is it for this chapter. This will be our last video of this chapter, and I hope you would understand. Alright, guys, let's see you in our other videos. Till then, take care. Bye bye.